Are your investments safe from a financial collapse? A couple of different angles to take on this. I think so many people throughout the US and globally have money parked in exchange traded funds, mutual funds, all of these markets that own Apple and Amazon and these major stocks one way or the other. And today we're going to break down, are those vehicles safe from a collapse to the banking sector, which has been very vulnerable here in 2023, but also are those stocks that your investments hold, are they safe from a financial collapse just in general in terms of the stock market crashing amid a financial collapse? So a lot to cover here today relative to your investments. First, I want to give a little bit of context for this potential for financial collapse that I have been alluding to. You, I'm sure, saw the wild price action from March until about May of this year. But it was really interesting to me to see that we're not far off of those lows, and very much is this story still in the water and creating, of the major stock sectors, financials really seem to be the most fearful one from the investor side of things. But you take a look here at the regional banks ETF and the crash of more than 40% from high to low here in 2023. And your gears start shifting of like, okay, if regional banks, and a few of them did, go under, have so many problems that they're had to be bought out by other banks and what have you. If this becomes, a wider spread regional bank problem, which you look at the price action, they haven't recovered to where we were at the start of the year. There's still very much a lot of fear in the regional bank sector. That can obviously break into the next tier of things, which would be financial companies at large. And then you start to talk about, okay, well, if I have, a BlackRock investment and they get caught up in some of this financial sector crisis, what does that mean for my investments at that fund? And we're going to break that down here in a second. But yeah, just wanted to give you this context because, still very much on the table. One of the worst performing sectors is financials here in 2023. And like I say, this is a market that moved from being $65 a share all the way down to under 40. And we're still barely above 40 here, as for a second there in June, July, and August, it looked like this market was going to shrug off that fear and get back to scratch on the year. Turned over to the downside in recent weeks, and a resurgence of this fear of people's investments and everything else. And here's the context for how much is built up in major financial advisors like BlackRock, Vanguard, Fidelity, State Street, JP Morgan. And, I'd venture to guess that most investors out there, passive or active, have some kind of exposure to these major five advisors here. And of course, BlackRock and JP Morgan are huge public companies that are huge components of the financial sector. And so, like I say, your gears start to shift of if there are problems for regional banks, then, how siloed off are they from essentially large banks or the financial sector at large? In the same way that, an apt analogy might be, you have your regional grocery store or store for goods. Maybe it's, Jewel Osco, Kroger, or what have you here in Chicago. We all love our Mariano's. And maybe on a regional level, there's some kind of crisis. They're having trouble supplying X, Y, and Z. And at some point, that crisis can roll into now Walmart and Amazon, and these huge, huge players in that consumer goods sector are also seeing the same issue. again, it's for the time being, it's been kind of siloed off, but can quickly turn. And you can see here in the price action between that same regional banks ETF that we looked at to start and JP Morgan and BlackRock. At the start of that fear, major financials moved lower considerably as well. You see there in the blue line, JP Morgan going from up almost 10% on the year to at its lows there, down almost 10% on the year. So almost a 20% swing. And then in the orange line there, BlackRock goes from positive on the year to down more than 10% on the year. In the same time, they've bounced back significantly. And JP Morgan's actually putting together a pretty nice year here so far. But if there is another resurgence of, not just 2 or 3 of these regional banks, but more, especially, interest rates in recent trade climbing back through those highs, and those interest rates were part of the problem with the duration mismatch that regional banks were seeing. Can that get into the regional bank space? And then what does that mean for your investments at a JP Morgan or a BlackRock or a Vanguard? Well, thankfully, the system is set up so that if there is some, financial sector collapse and JP Morgan everybody is withdrawing their funds and they're now getting called up by certain entities that they need to post X amount of capital. Can they reach into your investments at their wealth management office, or can BlackRock reach into your capital that's in their mutual fund or ETF, or can Vanguard do this? There are precautions set up for exactly this. And I thought it was interesting to paint the exact picture of what happens when you put your money with an investment advisor like this. There are actually custodian banks that protect those investors' funds. These are financial institutions that hold customers' securities for safekeeping. So the very simple roadmap goes like this. Individual buys X dollars of investment fund, and State Street, for example, another one of the major advisors that we just look at, they run the SPY ETF. And so when you put X dollars with that ETF as your, passive or active investment vehicle, that investment advisor buys the securities. You get X percentage of Apple and Y percentage of Microsoft and everything else. And the custodian bank actually holds the securities for the customer, creating a little bit of a degree of separation so that if something happens to that advisor, the custodian bank is actually the institution that says, hey, if you were trying to think of anything nefarious or trying to shift some stuff around on your books there, Investor Frank has this many shares of X, Y, and Z, and we're holding on to those and safeguarding those. Now, I don't want to paint too bleak a picture. Of course, you would hope that the investment advisor that you're using, BlackRock, Vanguard, or what have you, they understand that and they wouldn't think to that. But where we've seen problems in the past is when investment advisor and custodian are the same thing there. Thankfully, most of these places, all of these places, I believe, are regulated to have that separation. Now, where you're not necessarily safe is the actual risk of the market crashing. Financials make up, I believe it is around 12% right now of the S&P 500. That doesn't seem like a lot, right? And you might say, well, hey, Apple is more than 5% of the S&P 500. Microsoft is more than 5%. Amazon and Google and Tesla and these other stocks that are mostly technologies are way more exposure in the S&P 500 than financials are. Well, keep in mind that if that 10% moves lower by, 20, 30, 40%, a real financial collapse there are high correlations between each of these sectors. And now maybe the correlation between financials and technologies is only, positive 0.6 or 0.7 or what have you, or even positive 0.5, maybe even lower. A movement lower of 20, 30, 40% in financials, boom, right off the bat, that is, a movement of at 10% weighting or even more, around 2, 3, 4% of the S&P 500 directly, but then indirectly at those positive correlations, you would expect for a, let's say 30% move lower in financials, tech might move lower by 10% or 12%. And the other sectors that make up the S&P 500 might even have higher correlations to financials. So keep in mind, I mean, that's just the risk you have with risk on investments. But a couple of different ways to think about if this regional bank crisis is going to resurface or something else comes out as a new financial crisis like we've seen historically. Your investments, are safe thanks to regulations and everything else. But the exposure in the market is obviously a very real risk.